Chapter 21, Stocks, Bonds, and Mutual Funds. Learning Unit 21-2, Bonds. Read, calculate, and explain bond quotations. Compare bond yields to bond premiums and discounts. Sometimes companies raise money by selling bonds instead of stock. When you buy stock, you become a part owner in the company. To raise money, companies may not want to sell more stock and thus dilute the ownership of their current stock owners, so they sell bonds. Bonds represent a promise from the company to pay the face amount of the bond owner at a future date, along with interest payments at a stated rate. Once a company issues bonds, they are traded the same way stock is traded. The bonds section of the newspaper shows the bonds that are traded that day. The information given on bonds differs from the information given on stocks. The newspaper states bond prices in percents of face amount, not in dollar amounts, as stock prices are stated. Also, bonds are usually in denominations of $1,000, so the face amount is traditionally $1,000. When a bond sells at a price below its face value, the bond is sold at a discount. Why would a bond sell at a discount? The interest that bond pays may not be as high as the current market rate. When this happens, the bond is not as attractive to investors, and it sells for a discount. The opposite could occur and make the bond sell at a premium, which means the bond sells for more than its face value, or that the bond interest is higher than the current market rate. Look at this newspaper information for Aflac bonds. The name is given as Aflac. The bond interest is 4%. The company pays interest semi-annually, and the bond comes due in 2023. You see the current yield listed, the number of bonds trading, and the close amount, and again in a percentage, and the net change from the day before. So the last trade of the day was down 1% of the face value from the day from yesterday. The yearly interest on a bond is calculated as the face value of the bond times the stated annual interest rate. So the face value of the bond is $1,000 and the stated rate is 4%. So the annual interest rate is $40. To calculate the current yield that is given, we divide the yearly interest by the cost of the bond at closing. We just calculated the yearly interest at $40, and the bond at closing here is 99.5% of the face value, or in dollars, that would be $995. Remember, this is a percentage, so 99.5% of $1,000 is $995. 40 divided by $995 gives you 4.02%. That is the current yield, is 4.02%. Here's another example. The following bond was quoted in the Wall Street Journal. 5 bonds were purchased yesterday, and 5 bonds were purchased today. How much more did the 5 bonds cost today? First, we need to calculate how much the 5 bonds cost yesterday, and we need to calculate how much the 5 bonds cost today, and find the difference between the two. Yesterday's price was $96,875 less 1.15. The net change. The price increased today. Today's close price was $96,875, and that represents an increase of 1.5% from yesterday. So 96.875 less 1.5. It was trading closing yesterday at 95.375. So the 5 shares at 95,375 times 1,000 face value. 5 shares yesterday would have cost $4,768.75. This right here is to convert your percentage to a dollar amount. Because remember, this is a percentage number of the face value of 1,000. Today's purchase is 5 shares at 96.875%. So change your percent to a decimal, multiply it times $1,000 to get the dollar value, times 5. The 5 shares today cost $4,843.75. $4,843.75 less $4,678.75. $75 difference. The bonds cost $75 more today than they did yesterday. Calculating bond yields. Similar to calculating stock yields. Jim Smith bought 5 bonds of Aflac at a closing price of 99.59. What is Jim's interest? Remember that 99.59 is the percent. So in dollar amounts, that is $995.90. We need to calculate the bond yield by taking the total annual interest of the bond divided by the total current cost of the bond at closing. Remember, no matter what Jim pays for the bonds, he's still going to receive $40 per bond in interest. That $40 is from our previous calculation because Aflac was paying 4% interest. So he has 5 bonds that he purchased. So he's going to get $40 of interest per bond each year. So 5 times the $40 of interest per bond. He purchased 5 bonds at a price of $995.90 each. So his return is 4.02%.